A very good morning to all our viewers. Hello and welcome to Morning Trade on Money Control with me, Stacey Pereira, and I'm here to help you navigate through this trading day, get you some actionable trading strategies as well as the sectoral trends that you need to be looking out for. But more importantly, all of your queries that we plan to answer during the course of this show. So keep your comments on our live feed and we'll try and have them addressed by our guest on the show. But before we bring them on board, let's see what we're getting from our global handover and what's that looking like. Now, stocks closed quite weak on Wall Street on the first trading session of 2024. The Nasdaq fell over 1.5% in its worst day since October, while the Dow Jones closed less than 0.1% higher. Apple shares were the ones that took it on the chin, 4% down after a downgrade coming in there from Barclays. And Asian markets too opened with some cuts. South Korea as well as Taiwan led those declines for the Asian markets as tech firms slide after that Apple downgrade. Meanwhile, the GIFT Nifty is suggesting a weak start for the Indian markets. And crude prices corrected. Brent slipped over 1.5% on Chinese demand concerns, even as the concerns continue to rise over the safety of shipping routes in the Red Sea. And the RBI proposes new rules on dividend payouts by foreign as well as domestic banks to be effective in FY25 onwards. The circular sets asset quality as well as capital adequacy conditions for declaring dividends, while also setting out dividend payout limits tied to asset quality. And the Supreme Court is scheduled to announce its judgment on the Adani Hindenburg case at about 10:30 a.m. today. Remember, the SEBI had completed its probe in the 22 of the 24 cases initiated post that Hindenburg report. Well, we have lots to be looking forward to, of course, that big crucial case in the Supreme Court. But let's look at markets and how they are going to react. We are going to see some reaction coming there on the stocks. In fact, if you look at just Adani stocks, the past year, they've tried to, regain that composure, though having set them there in the negative. But let's also look at the fundamental perspective and what's really going to be driving markets onwards from here in 2024. And joining me for that is Aishwarya Dadich, the founder and CIO at Fident Asset Management. Good morning, Aishwarya, and a very happy new year to you. But it seems like the markets have already priced in a couple of these factors that we're talking about in the macro sense of things, be it rate cuts, be it political stability. We'll see what comes out from the Supreme Court as well, because that could really, swing the markets, at least for today, if we have to say so. But how confident are you of the year as a whole in 2024? Are we going to see similar returns like the 20% we saw in 2023?
Good morning, Stacey, and Happy New Year to you too, and Happy New Year to all the viewers. Obviously, we had a great year in 2023, and looking forward, things are looking pretty solid. But one thing which I want to highlight to all the viewers here is market has discounted, as mentioned, about rate cuts and the growth part. But earning trajectory is something which market is still doubtful about. So what Street is expecting is a very solid earning trajectory in mid-teens to the large caps and possibly about 25 to 30% range for mid and small cap for this calendar year itself over the next financial year. And if there are any let go on earning trajectory, then possibly market can see some strong consolidation. So as we are entering this quarterly season, starting from the 11th of this month, it becomes very vital for companies to report earnings more or less what Street is expecting. And obviously, there has been, some noise about the Red Seas and freight rates going up, and possibly the whole inflation context, which we are expected to see moderation coming up as the vegetable prices goes down in the coming months. So if we see any spike on account of freights and fuel charges or something like that, possibly it can provide a small, I would say, hiatus to the market or the consolidation to the market in short term. But if I see the whole year, I expect that if earning trajectory stay put, what the Street is expecting, possibly this could be also a good year. That's what more or less compared to what we saw in 2023, but with more volatility. Because we have, valuation is possibly not in our favor. We have one big event in May. Obviously, market has already discounted that existing government possibly will continue with the kind of results of the state election that we have seen. but volatility will be the talk of the town in this calendar year. And second thing is, what we believe is that possibly large cap is somewhere where now the smart money will start chasing. Mid and small cap valuations are providing area of discomfort for sure. And this outperformance of mid and small cap over large cap possibly more or less is toward the last leg of this rally. So, the rotation toward large cap, and even if the FIs come around the corner, we will possibly seeing more support in large cap compared to mid and small cap. So that is where, we believe that, markets will behave in this coming calendar year.
Right. So that was a broader perspective on what can really happen in the fundamental side. But what are the charts really saying? Are they actually following that up? Is that what we're seeing really play out as well? Let's look at how the charts are performing. And joining me for that is Himen Kapadia as well to give us the technical analysis. Now, if you look at the Nifty 50 yesterday, at least in yesterday's session, we did see quite a lot of volatility, and pretty much we would say maybe the bears are somewhere, looming around there, trying to also take control. But definitely that negative bearish sentiment is what one is kind of feeling at this point, with the support levels of 21,500 or even 21,300 in that zone. But that negative divergence, one would suggest, is a potential cool off for the recent uptrend, at least if you're seeing. And similar with the bank and Nifty as well, because we've not seen them perform, and now all of those components of the bank Nifty are really the ones that were trying to bring that do a comeback at least of sorts. So Himen, what would you say whether for the both these indices, the Nifty as well as the bank Nifty, what would be the levels that one should be tracking for at least today?
A very good morning to you, Stacey. Thank you for having me. Yes, I think, like you said, there is some sort of negativity in the sense. It's very clear, Stacey. We've had a phenomenal move. In a sense, it's almost 3,000 points, if I get this correct. Yeah, it's almost a 3,000 point move as far as the Nifty is concerned. We are stretched. We are overbought. Traditionally, if you see for the last, if I remember this correctly, of the last 16 years, 12 years, January has seen markets cool off, correct, whatever terms we use. And currently, some of the mechanical indicators are already showing signs of that happening. Some of them have given a crossover sell. And the bank Nifty that you mentioned, Stacey, I think that is showing a little bit more weakness. We've been down for 4 days in a row. So yes, I think a correction seems to be around the corner. But the way I see it, Stacey, it seems more like a correction in a bull market, in the sense it's not a trend reversal. Yes, if we're going to, let's say we move from 100 to 200, we'd expect it to come down by 25, 30 points, which is natural. And that, like you mentioned, we seem to be on the cusp of doing that. So yes, I think for a couple of weeks, it wouldn't harm us to consolidate, correct, and, give a technical term, time and price retracement, Stacey. Levels that you spoke about, the way I see it on the upside, 21,800 is important as far as the Nifty is concerned. In terms of resistance, support 21,583 and 21,365. These are support levels on the downside. And similarly, if we are talking about the bank Nifty, I believe 48,600 is important as far as the bank Nifty is concerned. And before that, you also have 48,200. These are resistance levels. Support comes in at 47,600, 47,200, and 46,919. So these are some of the levels one can watch out for. And I totally agree with your assessment. There is a little bit of a negative overhang being seen on the charts. I believe it might deepen, but we'll have to wait and see.
Right. So the bigger question then remains that in such kind of a market scenario, where should one be really putting in their money? Now, we are already looking at this correction, and perhaps that is what is likely to come even in the run up to the election. So Aishwarya, what would be your assessment? Should one be looking at the mid caps and stay safe, or one shouldn't leave out the large caps because that's where you find safety? So what would be your strategy when it comes to playing this market?
I believe the smart investor will start allocating money to high quality franchise in the large caps where they have better visibility about the earning momentum. I believe, that easy money making is more or less behind us, right? So it's very important that capital preservation and protection should be the theme for this calendar year. And what better to, park your money, hard-earned money in better quality franchise of large caps. Now, I'm not completely ruling out. So, because see, what I understand is obviously this momentum. Once we get the outcome of this election, then possibly we can see, this momentum going to some even on a higher precious level. But that is not for SN investors. So I would, repeat that they might be market might be waiting for one, say unknown kind of an event, or even a non-unknown kind of an event to pull them badly down. So allocating money to mid cap, small cap at this point of juncture, at least we at Fident are not able to find opportunities. Right, there are very few companies who we believe that if the theme continues and if the momentum of investment continues, there would be like a couple of stocks in individual sectors where we can find opportunities. But majority of the segments in our assessment are overvalued or stretched. So market has ended up a lot, compared to what the earning estimation now. So that's why I'm repeating that point again and again, that if we miss out on earning, even this quarter or the couple of quarters in the coming times, the re-rating can be just a piece of cake for the market. So earning trajectory become very, very important in this point of time. And last important data which I was looking at yesterday, that why earnings are so important. If you see the last 4 years, market has Nifty has moved up almost 75, 76%. And earning growth has also been almost to the tune of 80% composite, if I see that. So it's almost like one-on-one earning growth to multiple re-rating of those companies has been. So that's from here onwards, it's very, very important that, we are slightly on a precarious situation where earning trajectory is going to become very more vital.
Right, so we'll have to really probably play it safe and look out for earnings, because that's going to really give markets a direction for now. But let's I would like both gentlemen to stay on, because let's address a couple of brokerages and what they are putting out. Now, there's a Jefferies note on banks that has come out, and they say that in 2024 banks can be maneuvered around with a slower rise in personal loans, and this especially after what all the RBI has come and done when it comes to those retail loans. And they're seeing that slower rise in personal loan will be riding that broad-based growth, at least in the SME housing uptick that they're going to see. There's also going to be an uptick in capex that will grow at about 15%, and banks will also need to maneuver around the slower deposit growth. I think one of our guests did mention about how that is going to be a factor that will play out, and how things pan out from there. They're also asking to be banks that will need to be mindful of the rate cuts that 50 basis point post-elections could actually happen, and as well as the elections as a whole would temporarily disrupt how PSUs are functioning. So let me bring Aishwarya back in and get his sense of, how the banking sector as a whole, but also with so many regulations that are coming in. In fact, in a bit, we'll also address the fact that yesterday the RBI came out with draft rules on dividends as well. So for PSU, banking PSUs, how is that going to play out? And is that something that one needs to look more carefully into?
If you look at how the banking has played out in calendar 2023 or even the last 2 years, it's one of those underperformers across the other sectors, and even in compared to Nifty. And when we look at the sectoral allocation, we believe the value lies still in banks, right? So one of the reasons, if we can ascribe for this underperformance, has been that RBI has been pretty proactive in bringing regulations, which has I would say stricter regulation, which has impacted those banking operational parameters in a strong way. But if I look at in the hindsight, or look at the positive side of it, I think it is providing more stability and strongness toward the whole banking sector as a piece. So we are positive on banking as a space, as we were talking about where are the opportunities. Possibly banking is one space when one should go overweight in banks. When obviously you talked about PSUs, right, and about the capex growth and the retail loan part of it. But if I look at those easy, low-hanging fruit for me in PSU banks, is obviously first is this yield softening, and it will have a positive impact on the income of this PSU bank compared to the private bank. And second is, if you look at, obviously we have seen about the deposit growth has not been in sync with the advances growth over the last 2.5 years. And so if you look at the CD ratio, even in that side, I would say PSU bank has an upper hand compared to private banks. And the impact with the fall in rates will be slightly little more pronounced in private banks compared to PSU banks. So PSU banks, where valuations are still more, I would say comfortable compared to private bank, and their ability to finance those government capex and the private capex, possibly PSU banks still have value. If I look at hard way to find out the value gaps in the banking space. And on the private banks, we believe we like more of a large cap names. We believe that they should be able to do 15% plus kind of an credit growth for the FY24 plus, and there might be some moderation in NIMs. But asset quality moderation is not visible, at least for the next 7-8 quarters. So earning growth of 15-20% is quite doable for banks, and valuations are still not out of hand. So I believe some of the smart money will move toward banks in this coming quarters. We saw the Federal's update yesterday, not very encouraging, but I believe majority of the large cap players will show strong credit growth momentum in their results in this time. And most important point is when this fine money, they start coming up in India, it will be chasing banks. We know that we have almost 40% plus kind of an 30 to 40% kind of an exposure to various indices. And when all this basic money or even the discretionary money comes back, a lot of it start following banks is what we believe. So banks to us looks very exciting. Is one of the area where we can safely invest for those 50-20% compounding for the next 2 years.
Right. So I'll stay with the banking space because a couple of queries are coming in now. Pooja Mehta is asking on the outlook for Bank of Baroda as well as Yes Bank, as well as whether there's another one from Wisdom who's asking the sentiment on Bank Nifty. So I'd like Himain to come in there and give us what really one could be looking at when it comes to Bank of Baroda, Yes Bank and the Bank Nifty index as a whole.
Well, standalone Bank of Baroda looks good, Stacey. We've posted, I believe, what is a fresh all-time high. Having said that, shorter term, there is distinct heaviness creeping in. The stock is overbought and stretched. It's ripe for a correction. We need a closing about 236 for a couple of trading sessions if it has to continue the move. And on the flip side, we are at 230, not very far away. We close below 228, we slip into a corrective phase. So Bank of Baroda, I would say near term looks stretched, longer term comfortably placed. But I would say if you want to consider it fresh, I would prefer to look at it from a buy on a decline point of view. Yes Bank has been disappointing, has disappointed over the past years. Currently, technically, it is ticking all the boxes. Looks good, rounding bottom, mechanical indicators buy, seems to have exhausted a protracted, prolonged correction, seems set for a further upside. Bank Nifty is in the midst of a correction on the daily chart, which I believe might convert into an intermediate correction. The setup remains unequivocally positive. Long-term charts seems fine. We are in a long-term uptrend. But yes, currently, we've had a scintillating move from 43,200 to 48,600. We need to correct this rise in terms of a time and price retracement. That is what we are probably undergoing.
Right. Okay, so let me tell our viewers about what the RBI has done now related to banks. They've gone ahead and released a draft circular on the declaration of dividend by banks. Now, how is this going to happen? Banks will only get to declare a dividend if the capital adequacy requirement is met for the last 3 fiscal years. Now, banks will also declare a dividend only in the financial year if its net NPAs is less than 6% that year. These are the criteria that the RBI has put out. Another one being that they will declare dividend only if it complies with all of RBI's rules and regulations. Now, there is also a cap given of how much one can actually put out. Now, the maximum dividend payout will be, the ratio will be set at about 50% if the bank's net NPAs are 0. So that's quite important because that barely is the scene. So a 50% dividend, you're perhaps not likely to see any of the banks give. Now, the max dividend payout ratio will be set at 40% if the net NPA is less than 1%, whereas the max dividend ratio will be set at 35 if the net NPA is equal to or less than 1%, equal to or more than 1%, but less than 2%. Another one is the other criteria is you can give out a dividend of about 25% if the net NPA is equal to or less than 2%, but greater than 4%. So that's going to be interesting to see how one really plays out these different criteria that the RBI has put out, because it's quite interesting. Most of your banks come within some of these range. So the dividends that investors will get will perhaps now look dwindling, we could say, if one needs to address that. But also let's address a couple of stocks that will be a buzz today. One will be Avenue Supermart. This has come out with its Q3 revenue growth, which is at about 17.2% on a YOY basis, coming in at 13,247 crores. We're also seeing, this remember is the one that operates D-Mart and those chains, and they've clocked in that standalone revenue. We yet to see, this is just a business update that they put forward of their numbers, but they've also shown an increase in the total number of stores, which as of December stands at 341. And as we're speaking of Avenue Supermarts, I thought let's address the fact that yesterday there was a huge bulk deal that took place in VST Industries, and one of those buyers that was perhaps locked in that upper circuit of 20%. But once we get to know what those trades really came off, we saw that it was Ace investor RK Damani who bought in about 2 lakh odd equity shares, equivalent to 1.4% of that paid up capital in VST Industries, at that average price of 3,390 rupees. And the value of that block deal coming in at about 75 crore rupees. So a lot of action there that we saw. Mr. RK Damani also back in the, we could see in the bulk trades or in the big deals that we see. But let me go back and get a couple of more queries answered for that matter. Right now we have somebody who's asking on Rakesh, in fact, is asking on Tata Motors. He has already about 120 shares that he had bought with a profit of around 18,000. He's asking whether he should book partial profits and then add at a lower level. He's asking you to suggest him in, as well as give the levels at which he can correct and so as to add at which level. So what would you suggest for Tata Motors? Because we've seen quite a bit, in fact, that being the shining star, one would say, of 2023.
Yes, Stacey, absolutely has been a shining star. Not very many levels to go on, simply because we're at all-time high, Stacey. So one level which has just been recently formed, it's untested. It's around 803. This is where we can expect resistance, and it's not, frankly speaking, very far away from current levels. If you're going to sell it over here, I don't see any sell signals coming in on technical parameters yet. But if I were to sell at this level, firstly, we need a closing below 780 for it to go down, and possible levels where he can buy it back come in at around 734, 735. If he does not want to do this, if he holds on, I believe in 2024, with some checks and balances, the stock is set for another 100, if not a 150 point upside from here. So if he wants to do this sell and buy, he can do it. But like I said, currently I don't have any signs of a decline coming in as of today's charts.
So, Rakesh, I guess you just have to hold on to it, at least for this point, because it is already at this high, is what Himain is suggesting. So, you should really stay put with Tata Motors, at least for now. But let me go back to Aishwarya and get a broader perspective. We've been talking about how financials will perhaps be that big theme this year, but also IT and consumer discretionary. A lot of the guests and market experts that we speak to are really, betting on these ones. Would Aishwarya want to agree with those themes, or are there, some contra plays that could actually play out in 2024?
Yeah, so obviously, apart from banking, we like IT. We have discussed that in many times the previous time also, that IT is one sector which has been, not in the investors' favorite list because of, the very tough couple of quarters that we have witnessed across both large cap IT as well as, mid and small cap IT. But if you look at, the whole risk of US getting into recession and, Europe under a lot of economic stress is not unwinding the way market has expected it to be. Right. And we are seeing initial signs of Europe showing stability. We are seeing that possibly US going into recession is the likelihood is far, far lesser now. And obviously on the interest rate, which has a very important impact on this technological stocks, is also taken a reversal or kind of a U-turn because of this, dovish stance which Fed has taken. And we expect calendar 2023 to be a year where we'll see interest rate happening across the globe. So it will bode very well for IT stocks. And I will see that a lot of smart money has already have been moving to IT stock for the last 4 or 5 months, in spite of not being a very strong operation performance. We are entering this third quarter, which is December quarter, where we have normally seen, because of the furloughs, this quarterly seasons will expected to remain weak. You will not be surprised to see a couple of IT names also showing negative growth on quarter-on-quarter basis. But if we have a 2-year view, we believe that over the next 2 quarters, we will see more stability coming through. Because if you really look at the deal pipeline over the last 2-3 quarters, has been very, very strong. And the leakages which was happening for many of these companies will possibly stop in the coming 2 quarters. And all those things like that the wage cost and the subcontracting expenses which was hitting those companies 3-4 quarters down previously is a thing of the past. So we believe not only the growth will revive, but also margin will see more stability in the coming quarters. So IT to us looks very, very interesting. The problem is that majority of the mid-cap ITs catch-up has happened very fast. So we see more value in large cap IT and select few mid cap IT names where investors can stay put for the next 2 to 3 years, where we can see money compounded at 15-20% easily. So that is what we like about IT. Other areas, if you know, so consumer discretionary, as you mentioned, is also one of our favorite. We believe that possibly we are seeing some slowdown in rural side and even possibly also in the urban poor. But there is no dearth of demand in discretionary space. So the demand momentum is very, very strong, and we are very, very positive on the consumer discretionary side. The only area which was impacting this segment was high inflation, which was eating out the margins. But we believe we have already seen it in the last quarter, and we believe it will remain the trend that we will see moderation of inflation will abate into the improvement in margin for consumer discretionary names. So that one story, we believe, have a strong narrative about growth on the consumer discretionary side, which should do well in the coming times. Other area, same like what happened with IT, we believe the same thing is happening with pharma names. If you look at the pharma, all 5 segments of pharma, whether it is export-oriented or domestic IPM market or CDMO, CRO, or even healthcare and possibly diagnostic, we are seeing good amount of traction has built up over the last 2-3 months. Most of these companies have seen money flowing into that, and we believe people are expecting that there will be revival in pharma sectors in coming quarters. So I believe there is some opportunities available in pharma space too, apart from IT and consumer discretionary space.
Right. So that's the different call that you're making. You're also looking at pharma. And in fact, yesterday, the pharma index was the one that touched record highs. And we had almost 4 out of the 6 of the top gainers on the Nifty coming from that pharma pack. So that is something that Aishwarya is saying you could look out for in this year as well. But let me quickly, because we are running out of time completely. Himen, your picks for our viewers today, what are the stocks that you have on your radar?
Firstly, a buy on Adani Enterprise intraday call at around 29.30, stop loss 2900, target 2990. The other stock is a positional buy call on Cipla. It's breaking out of a prolonged consolidation phase on the monthly chart. Prolonged, I mean around 5.5 months. One can buy Cipla at around 1280, stop loss 1255, target of 1330, positional buy call from a medium term point of view.
Right, Himen, today on a day when you have the Adani Hindenburg case in the Supreme Court as well, that would be quite interesting to see how that stock really reacts to all of that news. But it seems like we are completely out of time on a morning trade, and I would like to thank both our guests for giving us their suggestions and their picks. Aishwarya as well as Himen Kapadia, they're giving us their outlook on 2024 as well as what strategy they should be using to navigate this market scenario. But and to all our viewers who've been sending in their queries, hopefully we've addressed some of that. But if not, don't be disappointed. We'll be back here tomorrow and get those queries answered for you. But for now, it's a wrap on a morning trade. We'll be back with opening bell shortly.